Guess what, guys? I am such a cheapskate. This is what I geek out on. I'm so excited that you're going to take 20 minutes and hang out with me for a little bit. This is not designed to be all-inclusive of all the options, but I want to help you make a quick shift so that 2018 is your year, right? This is time to reboot your revenue, okay? So I'm honored that you're here. I'm excited to share with you. So let's get started. We're going to talk about 5 reasons your job and wholesaling real estate keeps you broke. Now here's what's going to happen. It's tax time, and you've probably had your accountant for years, and he's a generalist or she's a generalist, and they never told you this information. And so you're going to be tempted to lace some brownies and send it to them for a gift with laxative. Don't do that. It's up to you to do your strategizing, because there's a huge difference between tax preparing and tax planning. Your accountant is not there to do strategy with you. They're there to take the information that you give them and play expensive calculator games. Plug it into some software, give it back to you, and that's it. And they're herding cattle because it's a busy time of year and everybody's coming and everybody wants it done. So they spend a couple of minutes and they do plug and play, and then you don't know these type of things. But we're going to change that for you today so that you can have an intelligent conversation with your CPA or accountant so that we can take it to the next level. All right. I'm going to ask a quick question. If I earn, meaning me, $450,000, and you earn $450,000 at your job, who earns more money? Or let's say you earned it in a wholesale deal. Which one of us earns the most money? What you're going to make after these couple of minutes is a shift. You're going to make a shift and understand that all money doesn't earn equally. Well, what qualifies me to tell you this? My name is ValerieTrent. For those of you who don't know me, I am a real estate investor CFO. What I do is I do the tax strategy, tax planning, tax optimization, profit loss, and maximization for real estate investors. That's who I love. That's my niche market I work with and I serve. And my job is to help take you, whether you're a wannabe real estate investor, new real estate investor, a mobile real estate investor, but your statements and your profit margins just are not looking right. My job is to help you become a rainmaker. In being a rainmaker, you're not just making, you're keeping, but you're doing so with maximum profits, maximum protections, and maximum privacy, meaning predators, leeches, people who want to, capitalize, opportunists do not know what you're doing. So we keep it private. And you'll be able to show your tax returns because we create privacy even on your tax returns. And that's something that a lot of generalist accountants and CPAs don't understand. For our niche is we don't need everything exposed so that if our tax records are subpoenaed, we're just kind of flying in the wind. So the reason I talk about my journey is because I want you to understand that I was not always a real estate investor CFO. I did not always know these things. I came from an orphanage and it became incumbent upon me. You have no idea the time, energy, and money I've spent to get this information, and not just to get it, but to understand it at such a level I can explain it to a 4th grader, and it works. I am so risk averse. I've lost enough in my life so that I wanted to not just know how it works. I don't believe that there's risk, and I've been validated by the wealthy people I have had an opportunity to work with. So I went on and got all the education I need to qualify myself to talk to you, an Ivy League master's. You don't have to do that, but I did. I have a 663, meaning I understand market-based products. I understand the best ones to use, which ones not to use. I have a producer's license, which gives me inside information to alternative investments and how you can just create legacy. Legacy is what it's about. And I have more than 2 decades of real estate investing experience. I am a current real estate investor, so I get it, guys. And in return, I've been able to help hundreds of clients create 6-figure profit margins, multiple 5-figure to 6-figure tax savings. I'm talking if $50,000 in tax savings does not excite you, 75, 100, then you probably, don't need to be on the call. Save it for those of you who do need these kind of savings, and we can do this pretty immediately. So this is a really, really profitable video for you. The other thing is, if you do any research in 401ks, everybody since 2001 that's retired from a 401k has had to go back to work. There's plenty of information out there on why 401ks do not work. They were not designed to carry your entire retirement. They were supposed to supplement. But when they did away with pensions, well, here's what we have. And there's a lot of reasons for the discrepancy, but what happens is when you get into retirement age and you're just dependent on 401k, it's not going to sustain what you need. Your medical costs alone are going to wipe you out. So then there are also, I've had the opportunity to create diversified passive income strategies, and those are strategies and income opportunities you can take advantage of immediately. So from my journey to the bottom, now we're here. I'm honored that you've taken the time so that I can share with you. All right, so I've got another question for you. Did you know that our tax system plays favorites? And it has nothing to do with race. It has nothing to do with anything except knowing the rules, right? And so a lot of times we get a little miffed when we hear about all of the benefits for businesses and corporations and wealthy people. But the truth of the matter is, it's about what you know. It's not about what you look like. So our tax system, mainstream will tell you that in order to take advantage of maximum returns, you've got to take the maximum risk. Well, guess what? That's not always true. Our tax system has a way for you to take minimal to zero risk and reap maximum rewards. And I'm not talking about 20% returns, or I'm talking about infinity rates of return, never paying taxes on the money. We pay enough taxes. I'm not saying that we are evading and that I don't like to pay taxes every time I buy gas, food, retail. I'm paying taxes. And then we do pay our fair share. I'm going to tell you why in just a moment. But we do. We pay our fair share of taxes, but you do not have to overpay. What you're about to discover by hanging out with me for about the next 15 or so minutes is why some of us do not pay taxes on all of our income every year like you are, and what that allows our bottom line and quality of life to do. Got a surprise for you. Wealthy do not have wealth secrets. What they do have is education. They start them from babies. They inherit it. It's passed down through generations. And so I'm going to help you get a sneak peek into what it is that they know that we may not know. And I hope this helps you. I'm excited about it. I thank you for, making the investment. And let's get started. I'm going to dive right in. So the next slide is wealth strategy number 1 of why you're broke. There's a Grinch to W-2 income, and it's called You're Not Understanding How Marginal Tax Rates Work. What are you talking about, Valerie? What are marginal tax rates? Looks something like this. Remember we talked about the 450 example? Well, how it works is on the first 18,600 of income for 2017, I'm only going to pay 10% in taxes, okay? First 10% of wholesale money I make, I'm going to pay 10% on the 18. For every amount up to $75,900 from the 18, I'm going to pay 15%, so forth and so on. So what you are noticing is the more I make, the more they take. When it's done under the column ordinary income. And so when you get a job, you're all excited, you're ecstatic, and these numbers include short-term capital gains, which is something you need to really pay attention to, because a lot of working America or quick fix America subjects themselves to short-term gains, interest income, and they mix it with ordinary income. If you stop here, you've learned all you need to know to stop doing this. So anyway, let's keep it moving so that you can get to the next point. So we got the first one. Understand that ordinary income punishes you. The more you make, the more they take. Next one. The second thing that's keeping you broke in wholesaling and in your job is not understanding that there is something called credit. And if you leave it up to your accountant to just know these things and you don't go behind and do checks and balances and say, hey, did you consider this? Did you consider this? And stay on top of it, which most of the time we don't do. And this is just general information for real estate investors. Oh boy, there's so much more, but I've got a few listed here on the slides. I am not going to go through them. You can do your own research for the sake of time, but credits are things like foreign income credit. Oh my God, if you just look that up. Lifetime earning, energy credit. Real estate investors, please look up the clean energy credit. Oh, I have so many examples of people that I work with that have just really done well. It's like 30% of whatever you pay is back in your check. Like, just look some of these things up, okay? Earned income tax, American opportunity tax, things like that. Just look it up. There is opportunity for you to reduce dollar for dollar the amount you're taxed, okay? So if we were to go back to our 450 example, and let's say we, put in solar roofs on our houses, and that job was 100 grand. Well, 33,000 of that we can get a credit for and reduce our taxable income from 450 minus 33 exactly. And of course, there are other things that we can do to write off so that we literally dollar for dollar reduce our tax liability. So we're going to go on for the sake of time. And I want to talk about wealth objective number 3 so that you're not broke, and that is deductions. Now, deductions are different from credits in that you're able to get a percentage of what you spend or what it costs you off on your taxable income. Now, the thing about the new tax reform that Trump has done is when you're a W-2, you're limited. Well, if you can't beat them, join them. Don't be a W-2. No, I'm not suggesting that you quit your job. I'm just saying you need to get some other things in place so that you can take advantage of what the benefits that are still in our tax system that you can take advantage of. If the big corporations are the ones that have all the benefits, then why aren't you a corporation? So we can help you, especially real estate investors, understand how to position yourself so that you can take advantage of these big breaks. All right, so let's talk about deductions. The deductions for those of you who are W-2s going forward, 2017, nothing has changed primarily. It's pretty much the same. But going forward, you're going to have to make some adjustments. And deductions for you going forward are going to be limited. Doesn't have to be, and we can talk about what you need to do to change that. But what do some deductions look like? I'm not going to go through them in detail, but here you go. We've got business and investment losses, charitable donations. Yeah, you can choose not to contribute to the taxable income that goes to fund wars and say, you know what, I'm going to give money where I want to give it. I'm going to donate to a charitable cause that I want to donate to, and you get that deduction. Charitable donation percentage deduction, business expenses, mortgage interest, thanks to Mr. President, but that is going forward limited for real estate investors, but trust me, there are enough other things we can still take advantage of that makes it profitable. So those are some of the things that you can not be broke or increase your savings on your W-2 income in deductions. If you don't do that, you'll continue to see yourself kind of behind. So again, if we go back to our example for, first we deducted our 33,000 in credit. If we have another 20,000 in deductions, now we're down to 400,000. Doesn't make a huge bit of difference, but it looks like we, instead of paying 35%, we're in the 28. That's savings for you. So just being able to save you 7% interest, or in taxes, if you do the math, that's $7,000 for some people, depending on how many hundreds of thousands you're talking about, that's $28,000. So this is how we're able to help you reduce your taxable income, and we'll tell you what to do with that, or what wealthy people do with that as we go on. So here we're going into wealth objective number 4, but before we do that, I do want to reiterate, when we create these savings and we show you where to invest, not the market, everybody listen to me, whatever the mainstream is doing, wealthy people do the opposite. There is a way to invest that's going to really make you salivate. It's going to make you upset because you didn't know about it before, but properly invested savings create wealth. So what's number 4? The 4th thing that's keeping you broke is not understanding this major piece of information. Wealthy insure everything. And we know what insurance is. If my house burns down, right, and I've got the money in the bank and I can pay cash for it, would I rather pay cash for the burnt down house out of my bank account, or would I rather allow my insurance to pay it? Well, you can insure more than just your house. You can insure your money. Wealthy people insure everything. Want to know why they insure their money? Because they love their money. Wealthy people do not, I cannot call a wealthy person and go, oops, the Dow crashed. Oops, this happened. They don't like losing their money. And so therefore, they don't speculate. What they love to do is maximize that word ROI. It's not a word, it's an acronym for return on investment. That's their favorite question. What's my return on investment? And is my investment secure? So while you're speculating and you're out there throwing everything at speculative products that you are unsure of what's going to happen, they are securing their capital in private capital reserves. Now, what in the world is that? You can talk to me further about that. I'm going to give you a little bit of its benefits, but when you want to know how you can do it, it's a number of financial opportunities or products. I can go over them with you, but they create their own private banking system, and I'm going to let you know that you can as well. So let me give you an example. Most of you know, if you were to save $8,000 in taxes, and we just showed you some of the ways you're able to save in taxes, not exhausted by any means, but if you put that in a 3% account, over 10 years, you should get about 91.7, and that's allowing for volatility, a little bit of ups and downs. If you put that in a 10% account, it'll probably get you around 127.5. So most Americans knows about the 3% account. Most of you probably can find somewhere to put it in a 10% account and get the 127.5. Either way, we've started the conversation that you're going to put this in your very own account, not the IRS's tax bucket, right? But what if you added some security to this principal investment? How much money would you have in 10 years if you put $8,000 in a bucket that allowed you immediate access to that $8,000 so that you could either do other investments, take a vacation, no penalty? Because what's the first thing that happens when you touch market funds? There's a 10% assessed penalty if you're not 59 and a half. What happens if you want to use your 401k and do some investment? You can't. You can do it for your first time home buying, but then now that's a debt. That's not an investment. Your first house or having a real estate house where you have a mortgage is a debt. That is not an asset. So what if you could put something in place where you could create an asset that allowed you to make more money? What if you could have tax-free access to that $8,000? Or take distributions over a period of 4 years while your kids are in college and not pay a nickel in taxes? What if you could leave that $8,000 or $127,000 or whatever it grew to, $91,000 to your heirs and there be no taxes? What if you could put in more to this bucket than just the minimum that you can put in an IRA at work? Your 12,000, 14,000, 26,000 if you're married, whatever the limits are. What if there were no limits? What if you could be protected from predators and creditors? If they couldn't levy or take the money from or put a lien against from, on this money for you. These are the things that wealthy people do. What if the growth is deferred? The taxes you pay on this money is deferred. So it gets to grow every year and you not pay taxes on it. What if when the market crashed, you could care less? You're only impacted when the market goes up. What if this money is allowed to compound? Remember we talked about the law of 72, which is, at whatever the interest rate, if you divide 11 into 72, your money is doubling every 6 years. The higher the interest, the faster your money doubles. Well, when you're dealing with real estate, compounding is ridiculous because the returns on your money is amazing. But what if you allowed it to do that and didn't have to pay money unless you sold it? What if you were allowed to create these reserves of the 91 or the 127 and make it a lending amount of money where you could become the bank for someone else or the bank for your own investment? These are some of the things that wealthy people do. But what you need to walk away from is when interest compounds in the right scenario, there are no taxes paid every year like you're doing on your everyday income. And I wanted to let that sink in a little bit because that's the difference mentally between what you do and what wealthy people do. That's what the big black ball is. Please let that sink in. But there also is another caveat. There is a way to allow your principal and interest to compound, and even if you touch it in your lifetime, you still don't have to pay taxes on it. What happens to your investment income? You get to write off what you contribute to your plans at the low number, but then when it grows, you now have future taxable income, that may be more than what you were allowed to write off. Again, it's capital gains. We don't know what capital gains is going to be in the future, but either way, we want to make sure that you can do that. Tax-free is always a better plan. So what happens when you allow interest and principal to grow without taxes and it compounds? You get wealth. And that's what I want you to understand is we can do a private plan, you and myself, and we can walk through exactly what you have in place. Are you structured properly? Are you getting the maximum amount of benefits in your profit loss? Are you job cost averaging properly? Can you with reasonable certainty predict what your monthly profits are going to be? Do you have income that's recurring and dependable? Is it taxable at the highest level? Those are the things that create wealth. But when you're a wholesaler and you have a job, you can't have those kind of conversations. So we can help you. Last objective, last thing that's keeping you stuck at work or behind the 8 ball is your inability to delay gratification. What I hear most people say is, I want to do a quick wholesale deal so I can get some money, but you have no way to offset that. So what we teach our students and what we put in place for you is the ability to acquire, acquisition, and hold. Now, what is so magical about acquiring and holding? And I'm going to tell you a little bit more about that as we go on. But when you acquire and hold, it's the difference between earned income, immediate income, ordinary income, and capital gains income. Remember that chart we saw where you had one side was ordinary income and capital gains and interest income, and the big difference between the right side? And let me see if I can get to that. Without doing a whole lot of scrolling. I cannot. So, but I'm going to go back to that probably before we end. But the difference is wealthy people pay more than 60% of all taxes, but they do so at the lowest rate, which is why they were so upset that Mitt Romney pays less taxes than his secretary. He's making millions, but his taxable rate is 15%. Because he doesn't make his money by you paying him income. He makes it from capital gains or whole money that is over time that he held longer than a shortened period of time. You, on the other hand, are paid quickly, monthly, over and over. And the reward for that is you end up overpaying what your cohort, the wealthy, pay. There's no reason to be upset. You can't beat them, join them. So remember, our tax system delays rewards delayed gratification. When you subscribe to your job in wholesaling, you subscribe to a model that forces you to churn and burn. And hopefully we're going to give you 3 things you can do to stop that immediately. The most powerful tool of wealth is when you understand that when it comes to money, any amount of money you hold 12 months plus 1 day becomes long-term gains. And the tax rate on long-term gains versus short-term gains is way different. That makes sense? So number 1, I want you to increase your income from capital gains income over the long term. Lower your earned and ordinary income. Most of your income should not be made from your job. If you choose to keep your job, please be able to offset that taxable rate with something long-term. I'll show you how to do that safely without risk and without losing access to it. Lower your earned income. Lower your ordinary income. Number 3, allow your money to compound, and the best compounding is tax-free compounding, and we can show you how to do that. So I'm going to take you back to the question that I asked you at the beginning. If I made $450 and you made $450, who makes the most money? You want to see? Earned income on $450,000, the way you do it as a wholesaler and a person with a job, you're paying $178,200 a year in taxes. Capital gains for me is, no, I'm not paying that money. It's allowed to grow. So if I have a principal of $450, I don't really have to pay anything until I sell it or until I do something with it. But how I structure it is I don't even have to pay taxes then. But let's say I had to pay capital gains taxes on the principal. My capital gains is $90,000. So I'm already ahead of you by $88,000, and I made the same thing, but I structured it different. So what if I put that investment of $88,000 into a 10% earning account over 10 years, 72 by 10, it doubles every, 7 years. So what do we got? $880,000 at the end of that earning period. You know how much money $88,000 alone is in the real estate world. That's a lot of money. Not when you don't know how to do it properly, because most of you will go and plop that on one property. $88,000 in the world that I teach my students is a lot of money, because the most you're going to have involved is maximum $1,000. Anyway, we'll get into that another day, another way. But let's say I park the money in the $88,000 in my account that's earning me at least 10% interest, but I don't surrender liquidity to it. So let's say I find a product that works for me. I go get $1,000 from my little pot. The rest of the money that's sitting in there is still earning, isn't it? I collateralize part of that money with infinite returns on real estate. I securitize my principal of $1,000 with real estate investment. I create a note or a deed of trust. I know it's complicated, but I just want you to understand that at the end of the day, wealth is created when you know what to do with the savings that not overpaying in taxes and not earning money improperly create. So wealthy people secures their principal. Remember, I took $1,000 from the 88, so it left me 87,000, where I can never lose it. It's getting above average returns in the double digits most of the time. I take $1,000 of that. I go create a note. If something happens to me, my collateralized, diversified, secured principal assets will leave my family about, I'm talking in the millions, tax-free. So I get to transfer wealth. They don't have to sell anything to pay for anything. And I also get to not only be the bank for myself, I get to be the bank for others. This is how you create wealth. And if you want to know more, there are a number of ways you can work with me. We can do one-to-one, and most of the time that's what I do. I work with about 10 people a year. That's because it's one of me. And I help them create wealth strategies that maximize. I look at every way they're structured. I look at all of their job costing, all of everything. Because yes, we do real estate taxes. Or you can work with a group. But you get to tap my brain. And what I've found out is that a lot of times people get stuck because you hear all of this wonderfulness, but you go to your accountant and you don't know what to say. Or you go to a deal and you go to try to do it and you get stuck. So what happens is we created the Real Estate Revenue Reboot family, and what you're able to do is tap my brain infinity. Yes, you get to tap my brain for $1.56 a day. If you run into any live deals, I will help you. I will walk you through it. I will do it for you while you listen so that you can learn. So one way to get to know if we are a good fit and can work together is you can get on my calendar at meetme.so/VLTSG, or you can email me directly at solutions@realestaterevenue-reboot. Either way, make that step so that we can help get you unstuck with how you're running your real estate business, but we also can make your real estate business profitable. It is my passion. It is what I geek out on. I love, 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 love it. You can work with me one-on-one. You can work with me together, or you can join our family. We have a Real Estate Revenue Reboot family where you have a group of people who are in the same mindset as you, and you're going to come to call them family because they're your colleagues. They love to have fun. They're forward thinkers. They're action takers. And you know why? Because I personally screen everybody who gets to hang out. But if you want to make a change this year, you're ready to get financially fit, get your money creating wealth, then get on my calendar. The link is there, or email me at solutions@realestaterevenuereboot.com, and let's rock 2018. Thank you for your time. It's been amazing hanging out with you. I appreciate you, and I'll talk to you soon.